Well, for some reason, I got the feeling that my comment about 99% of the guys who are trading don't know what these terms mean issue sounded a bit presumptuous of me, and how could I say such a thing, and who am I to say such a thing, and so forth. So this is a kind of a response to that as to why I said it. There's two things I want to bring up. One of them is that, again, I am talking about expert advisor trading, which I believe is an entirely different animal than manual trading. It's uh, uh, an issue on the front of programmers, for instance, in accounting for these factors, which I will tell you, I have never ever seen in any commercial expert advisor or any other expert advisor that I have come across on the internet. None of the 100 free ones I give away, none of the FAPs, none of the sharks have any provisions for this. And in fact, in giving one of my programs out for beta test on the MT4 forum, I had programmers tell me that the constructs I included to deal with the margin issues and stop outs and what I call equity protection was just got in the way of the strategy, was completely useless. Now, please, what does that tell you about who's programming these things? These guys have never traded. If you're going to completely ignore the construct of the market you're trading in and completely focus on nothing but what this is doing, it's ridiculous. You're trying to take this out of the constructs and then blame the brokers for the problem. It's not the brokers. The things that regulate how these prices move, these bar constructs, the nature of the whole market construct is universal. It's in stocks, it's in bonds, it's in every commodity that you want to trade. It has to be accounted for. It has got to be accounted for. And the more you understand about that, the brokers aren't. The only reason IBFX would publish this is because they're concerned about guys tanking their accounts because of they don't understand this stuff. Now you might say, "Well, gosh, I understand that term. I know what a bid and I know what an ask is, but how does it affect what you're doing in relation to everything else? How does it affect your margin vulnerabilities?" That's the issue here, and with expert advisors, there's no fudging. That's the difference here. There's no fudging. I can't say, "Oh, gee, I just missed that, and I'll catch it next time," or I can see this line has got a trend here versus these bars, and I'll just quickly dump this thing if I get in the wrong direction. That that doesn't happen. The expert is going to execute exactly what is programmed to do, and if you have no provision to cover you for any of these things, it's not going to do it. It's going to keep on placing orders on your execution strategy and till it doesn't have anything to execute with, or the broker shuts you down. The main trouble that everybody gets into, especially on the newbie side of things, is too big of lot sizes for relative to account, which is tries to be governed by the margin issues. These margins, by the way, uh, although IBF is blaming NFA for it, NFA is trying to keep people from screwing themselves. All these government regulations are trying to keep traders from screwing themselves by, and also trying to control the markets to keep them from getting so volatile that they can't be traded. in stocks, and you hear the markets, the exchanges will actually suspend trading sometimes when the spreads get too wide. Here in Forex, there's not that much regulation on it, but the margins will actually vary depending on the volatility. They're trying to manage the flow of this so it's actually tradable the way we're trying to trade it. And in the more say sparser markets like commodities, this is I mean you can be in a trade on a safe margin level in the morning and be stopped out and margin called by the afternoon if this type of thing starts to happen, and you won't even know what happened. And that's why there is such a thing as a margin call. A margin call isn't an email. Margin call didn't come from emails. It's not possible to even do it anymore. You tell me, well, I'm so good I never had a margin call. That's because maybe your broker's in Cyprus or Tangiers, and he's not going to call you if you're in Australia because he doesn't want to spend the money. He's just going to stop you out. A margin call in the old days was a time when you would actually get a call from your broker and says, "Hey, you're overextending yourself. Your margins drop below the 50% requirements, and you want to put some more money in your account before we stop you out, or what?" And in those days, margin calls were a measure of risk, and they still are. I don't know how they're accounting for it now with all this internet stuff, but if you had more than 3 or 4 margin calls, you're going to get another call that says, "Hey, dude, you're too risky of a trader for what we want to, what this brokerage wants to deal with. You could possibly put us at a liable risk if you get in a fast market and get to the point where you're in a negative. Guess who pays for it? Not you, the broker. He can try to get it back, but you've probably blown all your money in that deal. So, and they want to avoid that risk. So this is my whole point. I just wanted to bring up why my comment came out. I've never had anybody ever request anything to be put in an expert that had anything to do with these terms, any type of margin protection. So what am I supposed to conclude? 100% of the people I've talked to, the supposed even experts, have never, ever asked to have provisions placed in experts to deal with any of these terms. Nothing. Nada. So what? That's 50, 100 people out of a million, but nobody, not even 1% asked? That's what I'm coming from, okay? That's what this video is about. Thanks for watching.